Emmanuel raised his hand.
I can hear you.
Okay, fantastic. Thank you, Emmanuel, and welcome to today's workshop. Morning, Charmaine.
Yes, we're ready to get started. Everyone, welcome. Good afternoon, and welcome to Prince George's Community Federal Credit Union 2016 Lunch and Learn Series. Today's presentation is brought to you in partnership with Coffee, which is a nationwide financial coaching and education center that focuses on improving the financial health of individuals. As the premier credit union of Prince George's County, we have joined with Coffee to expand our mission of providing quality financial education to our community and lending insight into credit management, home ownership, and management. Now, Prince George's Community Federal Credit Union is a full-service financial institution serving anyone who lives, works, worships in Prince George's County, Maryland. We're one of the county's best-kept secrets with competitive loans, savings rates, as well as discounts at national realtors. We serve over 15,000 members in the area, and we welcome you to come and experience the benefits of membership as well. Now, later on in the presentation, we'll display our contact information to answer any specific questions you may have concerning your financial needs. Please note that today's webinar is live and all phone lines have been muted. If you have questions, please feel free to type it in the question field box that's located on the right-hand side of your menu bar. All questions are private and will be addressed at the end of our discussion. We will be offering a free 60-minute financial coaching session with the completion of 3 webinars in the series, and more information will be given at the end of today's presentation. Lastly, a recording of today's session will be available within 2 days. Details will be sent to your email following the presentation. Now, with that, we will turn it over to our presenter for today, George Rios.
Thank you, Charmaine, and welcome to this webinar on mortgages. Charmaine stated, my name is George Ruiz. I am a financial coach and a community outreach coordinator here in the Coffee program, and I'm looking forward to coach some of you in the near future, those that take advantage of our coaching offer. And today we are going to talk about mortgages. Let's start with, the definition. What is a mortgage? The mortgage note or promissory note is a document that you sign promising to repay the loan for your home. The mortgage or deed of trust ledges your home as security for the loan. So in simple terms, a mortgage is a loan in which your house functions as collateral. The bank or mortgage lender, they loan you a large amount of money, typically about 80% of the price of the home, and which you must pay back with interest over a period of time. If you fail to pay back the loan, the lender can take it home through a legal process known as foreclosure. Now, normally we can identify mortgages in 2 different types. What is a conventional loan and what is a government insured or guaranteed loan? Let's look into each one individually. So when we're looking into a conventional loan, these are loans that are not insured or guaranteed by the federal government. The 2 largest conventional mortgage providers are Fannie Mae and Freddie Mac. And they usually require mortgage insurance or private mortgage insurance known as PMI if the loan-to-value asset is greater than 80%. So when we think about conventional loans, normally we advise our clients, these are the loans that basically the down payment amount is normally 20%, but in some cases it could be less than 20% and still be a conventional loan. Now, we also have the insured by the federal government type of financial instruments. The three largest providers are FHA, the Veterans Administration, and the Farmers Home Administration. One thing that they all have in common is that they require mortgage insurance regardless of the loan amount. The benefit to this type of financial instrument is that they normally require lower down payments than a conventional loan. Some of the loans, like the VA loans, for example, don't require a down payment. And some of them is as low between 1% and just less than 4%. But one thing that they all have in common is that they require mortgage insurance regardless of the amount of the loan. Now, let's talk about who offers mortgage loans. Well, first of most, we'll definitely want to talk about your credit union. When it goes down to the different types of programs out there, it's something that when we're having the conversation, you should reach out to somebody that you know, somebody that is close by, and that this is what having a relationship with the credit union is so important. You can always stop by one of the branches, and they will definitely be able to point you in the right direction. We'll talk a little more about some of the programs that I have available as we move forward. But also savings and loans have programs that they can offer. Mortgage brokers, the seller, private lenders. We have nonprofit organizations, and of course, we have banks that's the one thing that they do. They offer loans and financial instruments that can help you to meet your needs. Now, we've got to keep in mind that there is a cost associated with the purchase of a home. When we think about down payment, and down payment is the difference between the home's purchase price and the amount of the mortgage against the property. And the down payment must be paid up front before the purchase of the home can close. We also have closing costs. That includes origination fees if there's any. Another benefit of using your credit union is that there's normally no such charges. We'll talk about that in a minute as well. There may also be points, appraisal fees, title search, and insurance, survey taxes. I mean, the list could be long, but this is actually what is known as closing costs. Cash reserves is a relationship between a property value and the amount of the loan against it. Also known as the LTVs, calculated by dividing the loan amount to the property value. So sometimes you may hear things like the 80-20. That means the lender will provide you with 80% of the funds needed to purchase a home while you are responsible for the 20% down. But there's other things to keep in mind as well when we're thinking about moving in expenses. You know, deposits for your electric and water utility services. Also, you may, if you are in a situation that you're paying rent, you may have to keep those at least for a month or so during the transition. Okay. Now, when we're thinking about down payment, it's the amount of money that you put down on the loan to reduce the balance borrowed. Okay. The larger the down payment, the smaller the loan balance. And from the lender perspective, when it goes down to it, insurance and why is it a requirement, the higher the down payment, the less risk to the lender. So when a client is presenting the application to the lender, if the down payment is less than 20%, this is where the mortgage insurance comes in. Now, things to keep in mind when we're thinking about mortgage insurance: it does not protect you, but it protects the lender. Okay. When it goes down to it, it becomes part of the mortgage, your mortgage payment, and it is important you understand the differences between mortgage insurance and homeowners insurance. Homeowners insurance protects your home from damages, while the mortgage insurance protects the lender from any losses that may be incurred. Okay. Now, when we're looking into, principal interest, when you make a payment, this is something that in the industry is known as PI, sometimes PITI. When you make a payment, a portion of that payment is the amount that you that goes against what is borrowed for the home. and the interest is the cost you pay for borrowing on the premises. Interest rates may be fixed or adjustable depending on the type of mortgage. We're going to talk about those, but normally when you hear the term PITI, then when you make a payment that is escrowed, it shows that there is a portion that is actually lowering the amount of debt, the interest that goes to the lender, and the taxes when we're thinking about PITI. Now, when we're thinking about fixed rate loans, they carry less risk to the buyer. Principal and interest payments remain the same throughout the term of the loan from the beginning to the very end. That does not mean that you cannot make additional payments as you can in order to eliminate the debt faster. But the good news for a client is that they have a clear understanding of what their payments are going to be from the very beginning to the very end if no additional payments are made. And that is a contrast to what is known as an adjustable rate mortgage. When it goes down to it, it is riskier for the buyer than fixed interest loans. The interest historically have never been as low as they are now. There is most people think that the interest rates will go up. They will go up. The good news to it is that they go up very gradually as the economy gets better. But they do offer other benefits. They offer a lower initial interest rate. And I know that Prince George's Federal Credit Union offers a few different programs, so you should talk to somebody in your branch. I know that they offer the 15-15 arm, and this is an adjustable rate mortgage that only adjusts one time after 15 years. That rate is fixed at that point for the remaining 15 years. But they also have a 5-5 arm, which is a very competitive rate, but only adjusts every 5 years instead of annually after the adjustment takes place. So it is important that you understand the adjustment periods on your ARMs and your adjustable rate mortgages. It's a fantastic opportunity for people to take advantage of the interest rates as they are historically low. If the intention is to remain in the property longer term, or gives you the ability to actually have a payment that is more affordable for a period of time, and as time goes by, it can adjust according to the economy. Because we have to keep in mind there is there's got to be a beginning, there's got to be an end, and this is where amortization takes place. Mortgage loans are amortized, so they can pay off on a specific date. And basically, this gives you a schedule or guide to paying off your mortgage early whenever possible, and saving thousands of dollars. So when you make a payment, the payment makes a difference. Okay. Now, when you are, and this is a term that comes up time and time again, you got to keep in mind that when we talk about the language that is used to the process, when you think about mortgages, a mortgage is a financial instrument, and it behaves in a very specific way. When you hear the term points being used, these are additional fees charged on a loan. Every time you hear 1 point or 1.5 points, that is going to be a percentage on the loan amount. Now, you can also discount points, purchase discount points to reduce the interest rates on the loan. That is something that you can talk to a mortgage specialist on the credit union. It is something that that you're interested on. Because when it goes down to the direct impact on the interest rates, it's something that will be felt, and you need to understand what's different between points and your annual percentage rate. Your APR, as that is known, is the total of finance charges including interest, plus loan fees, plus mortgage insurance, plus the points. Your APR will always be higher than the interest rate because it includes the loan fees. So when you are looking and shopping around for a financial instrument to purchase your home, regardless of who you're using, you need to make sure that you compare apples to apples or APRs to APRs. You need to understand, because this is going to have a direct impact on where your money is going. So some of the things that they use, your lender will use in order to to come up with the numbers in order to create that financial instrument. One of them is known as what is the housing ratio. And this is actually something that is very important because it determines how much of a payment will you be able to carry. It's also known as a front-end ratio in some circles. But this is actually the percentage of gross monthly income that the lender will allow you to borrow against. And it is comprised of principal, interest, taxes, and insurance. So just as an example, and this is something that to keep in mind, and I'm just going to use 33% as a housing ratio or front-end ratio. If your gross monthly income equals $2,500, if we take that number and we multiply by 33%, which is standard, that will allow a client to actually be able to sustain a payment of $825 per month. Okay, and that's comprised of PITI, once again, stands for principal, interest, taxes, and insurance. When it goes down to it, it is important so you have an idea of how much you'll be able to actually afford in order to sustain your home. What is also very important to keep in mind is that there's another ratio known as the debt-to-income ratio. When we're thinking about coaching and housing counselors, this is very important because this is what we call the back end. And it's basically same type of ratio, is just a little higher because not only does it include your gross monthly income, but also a combination of consumer debt. In other words, how much debt will you be able to carry when we keep in mind, when we add other type of debt? And things to keep in mind is that the lender will look into absolutely everything that comes out in your credit report that is actually a responsibility, okay? So if we take, once again, your gross monthly income of $2,500 as an example, and we multiply it by 38%, when you look into the different lenders have different requirements. 43% is not uncommon. But if you take your gross income and you multiply by that number, in this case we're going to use 38%, and we're looking at housing plus debt, $950 with a card payment of $300 and credit cards to use as a ratio. Okay. Now this it may seem complicated, but actually for somebody that is working in mortgages, in the lending institutions, they can run these numbers for you rather easy. So I don't want to discourage anybody. These, they may be complicated. Talk to somebody in the credit union. They'll be able to run that through you rather simple and put you on the right path of home ownership. Okay. Now, how do we get to that point? Well, the first thing is that we're thinking about the loan process. The first thing is actually go through an application process. Complete the loan application. Pay a fee if there's any. I know that we do not have any fees for the clients that are part of the credit union. So that's one of the great benefits of using Prince George's Federal Credit Union versus other ones. I've seen fees as from anywhere from $1,000 to $3,000 just for the application fee, depending on who you're using. So this is one of the great benefits and tools that you have available to you. When the lender begins the process in the application, they're basically looking into a lot of this information. And then when we talk about the front-end ratio and the back-end ratio, it is important because they can coach you and give you some advice on where are we and what is it that we need to overcome in order to go through the process. As we move on, the lender will request an appraisal, also a credit report, and will verify employment and financials. When you speak to a specialist, they actually will provide you with a list of documents to be provided to them. When you're going through the process, it is also going to be known as your truth in lending form, which is it is actually a law. They have to present you with what is known as a TILA, which is the truth in lending application, and it will basically show how is this financial instrument, this particular financial instrument that you are to sign, how is it going to behave? what is going to be the APR, what are going to be your payments, for how long, if there's going to be any restrictions, is it an adjustable rate or is it fixed? And the language is very simple, and it is actually a requirement when you're going through the process, okay? And basically the lender after that will take the loan information and also what is known as a good faith estimate. You get that prior to the closing, and this is going to break down what is what. You know, what are basically all the closing costs and all the fees that you're being assessed. And once again, you know, here we are in 2016. The language is very plain and transparent. You need to be aware what is it that we're getting into, what kind of financial instrument are we going to be using, how is this financial instrument going to behave. The process could be lengthy and it could be complicated, but that is why you need to make sure that you use the tools available to you. When it goes down to using Prince George's Credit Union, they have excellent reputation and fantastic individuals that can help us with it. Now, when we're looking into the valuation process, a lender is going to evaluate the application before they make a decision on the loan. Normally, you go through what is known as a pre-qualification process. And this is important because before you reach out to a real estate agent, which is also something that you should reach out to your credit union for. They do have fantastic tools available to you that can help you not only if you're purchasing a home, but also if you are selling a property. Reach out to the credit union. They can point you in the right direction. But it is important when you're purchasing a home because your real estate agent will require, in most cases, a pre-qualification letter to make sure that they are going to be showing you the properties that you may qualify for. If you qualify for a $200,000 home, they're not going to show you properties that are worth $500,000. So they're not wasting their time, they're not wasting your time. Because after, when we're looking into a third bullet point, basically if the loan is approved and a commitment letter is issued, then a closing date is actually scheduled. If not approved, they basically will write explanations and recommendations. So when we're looking into the process for homeownership, it is important that you understand the steps. One thing that we do advise our clients, first of all, take advantage of the tools available to you. When it goes down to financial coaching, it is a fantastic tool that can help you once you create what your financial goals are. They can help you achieve those goals. The two things that we see time and time again as obstacles are concerned with people that are looking into home ownership is actually credit and down payment. So you need to make sure that your credit position is strong enough in order to go through the process. But we coach clients on taking care, and basically the way I look at it is making the application look pretty. Because when you go into the process, you want to make sure that it goes through it as smoothly as possible. Not only that, but when it goes down to other things that come up is tools that you may not be aware of. One of the things that we work with our clients a lot is on creating a financial plan, not only for the down payment, but when you consider the 3 steps to successful homeownership, always think about it in a very simple manner. You must obtain, maintain, and sustain the property. So when we're thinking about sustaining the property and having a financial plan, it's very important. But when you go into a process of purchasing a home, you have to use all the tools available to you, such as grants that may be available in your area. It is a fantastic tool that we've got to take advantage whenever possible. When we're looking into different areas, one of the biggest issues that we encounter is actually affordable housing. So when it goes down to qualifying for a property for a certain price, if you qualify for a program that can assist you with a grant, you got to keep in mind that they do have a lot of requirements, but these grants and these funds do not have to be repaid. You know, they do have some requirements. You have to live in the property for a period of time. Some of them only require the minimum payment of $100 sometimes. But when it goes down to it, this is subsidized money. Most of the times the interest rate is zero until you actually have completed the requirements. Things to keep in mind is ability. It is on a first come, first served basis. There's a lot of different programs, so when it goes down to dealing with this program, it's always important you talk to somebody that may be aware of what funds are available when we're thinking about your state, your county, the city, and some of them, or the majority of them, are based on income and size of household. But it is something that helps equalize the market, because when it goes down to it, you need to be able to purchase a home that you can afford. When we think about the steps to home ownership, I always think about adding successful home ownership. I want to make sure that you obtain, sustain, and maintain the property in a way that is going to work for you. So normally, when we're looking into the things that you may need during the loan application process, first bullet point, application fee if needed. If you're working with Prince George Credit Union, there is no application fee. They may have a credit report fee. You do have the ability and the right to obtain a free copy of your credit report once a year. Picture ID, Social Security cards, sales contract if needed, if available. Normally, when you're going through a pre-qualification, there's no sales contract at that point, but you may be a little bit ahead. Tax forms, when it goes down to the last 2 years. And this is something that sometimes may be a challenge if you are a business owner, because at that point we are talking about profit and loss. When it goes down to documents, if you're single, divorce, or going through a separation, all those documents have to be available. Pay stubs, and when it goes down to the pay stubs, just as a word of advice, the clients that we're working with in my coaching team, always advise the clients to actually obtain a folder, and as they receive the pay stubs, that they continue to update the information. If we begin the process now in June, and the process takes 90 days, let's just say as an example, the lender will require this information to be updated. So this is not a package of information you're going to send one time and one time only. When it goes on to the pay stubs or anything that changes, your lender is going to require that information to make sure that we're still on the same page. When it goes on to your federal tax forms, of course, you need to include the 1040s, W-2s. Bank statements, just like pay stubs, need to be updated constantly. And if your source of income is retirement income, you need to have that information available to the lender as well. So when it goes down to it, it's not, when you're looking into the steps to homeownership, I mean, we're covering mainly the process to go through the mortgage process. When we're looking to homeownership, there's many steps. Recommendations that we give our clients is to work with a housing counselor that is certified by the Department of Housing and Authority. You may go into HUD, HUD.gov for government, HUD.gov. There's workshops, so first-time homebuyer workshops are conducted in a monthly basis on most places. Most places, there is no cost of attending those workshops. They do have certain requirements as far as the time and the material that they have to cover. Most workshops will last between 6.5 to 8 hours on one day, or they may split it on a course of once a week for a month. Here in our location, we do it once a month. But there's other options as well. They do first-time homebuyer workshops online as well, that a client can actually go attend a complete workshop at the privacy of their home at their own pace, and they do obtain a first-time homebuyer certificate That is also a requirement if you're getting any type of assistance, whether it's a grant or down payment assistance or closing cost assistance, and the right person to understand what programs you may qualify for will be the individual that is actually helping you to put the information through the credit union. It's a fantastic resource. It's available to you at no cost, no risk. They can give you an idea according to your situation. So when it goes down to reaching out to someone that can help us understand the process, have any questions asked, using the credit union should be your first option. Do we have any questions? I know that we scheduled for an hour, but as you can tell, I speak rather fast. Do we have any questions? Anything that we can assess during the workshop? Okay. And can you type the question on your right-hand side? Can you see my chat question? Okay, just give me a minute. I'm actually going through them. Okay. Yes, well, actually, the question is there a PDF on the literature that we're going over? The answer to that is absolutely. On your right-hand side, you should see handouts. We do have 3 handouts available. We have a PDF on avoiding foreclosure for those that are homeowners. We have a second PDF that is actually on housing and mortgages. And, of course, you will have a copy of the PowerPoint. So when it goes out to literature, yes, we have this information, and we can always send additional information if you have other questions. We have a number of different publications that we can help with. One of the most common publications that we have available is on credit. We have 4 different topics on credit. And that's actually the one thing that when it goes down to coaching my clients whose financial goals are to become a homeowner, the one thing I tell all my clients is like, we got to start working on your credit. And why? Why is this so important? Because it's a long process. You know, when it goes down to it, every case is different and individual. And when we're looking into dealing with credit, and one of the questions that we have, what is the ideal credit score? Needing to obtain a loan, the higher, the better. When it goes down to it, what is the lowest score available? Well, 350 points is the lowest. However, I usually advise my clients to get a 640. And this is where the difference comes in. I want to expand on this a little bit because we do have extra time. When you are approaching a lender for a financial instrument, you're not asking it for $10. You're asking it for $100,000, $200,000. So when you consider what is credit, and this is actually another of the workshops that we're going to be having in the future, credit, it basically is a representation of your reputation on how do we deal with financial instruments in the past. So the higher the score, the better it is. So if I have a 780 score, I will obtain a better financial instrument than somebody that has a 640. Now, all things being equal, that does not mean that your score is 620 and you may not be able to obtain a mortgage. But when you speak to someone in the credit union that basically works on mortgages, they'll be able to tell you, according to the guidelines that we have and according to everything that I see, this is what we need to create an action plan in order to increase your credit score between where we are now to what we need to be. One of the questions that we have, having information on refinancing. We do, and actually you can also reach out to the credit union because when you go into the credit union webpage, right in the very middle and in the very first page, they are running some programs as far as refinancing not only your home but also your cars. So it's one of those things that comes up. One of the questions I actually have, which is a very good question. So I was turned out for loan due to lack of credit history. I've been debt-free for over 5 years on purpose, and the credit union said I had to wait 2 years. And the way I kind of look at credit is like a beating heart. It's got to have a pulse. When we're looking into the challenges that we encounter into people that may have a good score, credit score is basically like knocking on the door. You're going to see a lender, you're going to knock on the door, and the lender is going to look at your score. And according to what your score is, they're either going to talk to you or they're going to tell you you got to get into and create an action plan in order to get to a point that we can look into the financial instruments that may be available to you. They will also look into your work history. What is, how long have you maintained the profession that you are currently working? Because when we're looking into an individual that has only been working for 6 months creates more of a risk than somebody that has the same profession for 5 years, 10 years. And I use profession because when it goes down to it, you don't have to be in the same company for 5 to 10 years. But I would really consider a client that is being in the same profession, even if he's changed jobs, much more than somebody that is going from profession to profession within a period of time. So when we're looking into a credit that is healthy, they look into having accounts that are being used, and by no means, I don't mean that you have to max out your cards when you use them all the time, but when you think about what is your credit score, it's based on a lot of different factors. When it goes down to having no credit score, or what we call ghost in the system, which is one of the questions that I have, I can't. When we're looking into a credit score and what makes your score what it is, 35% of your credit score is based on your history of payments on time. So they really look into the last 7 years, but the most important period will be the last 24 months. That is 35% of your credit score, or your FICO score. FICO stands for Fair Isaac Corporation, for those that might want to know. 30% of your credit score is based on your amount of debt that you actually carry. So if you go and open a credit card today and they give you a $1,000 line of credit, how much credit should you use? Well, who am I to tell you how much to use? You can use it all. What I'm really concerned about is how much are you going to carry over to the next cycle? And the answer to that should be 25% or less. I really push my clients to go to not to carry more than 15%, 1/5 of the credit available from 1 month to the next, because those two factors there make 65% of your credit score. Now, when it goes down to having no credit score or being a ghost in the system, something that I see from time to time, is one of the biggest challenges that I have, because when we are approaching a lender to generate a financial instrument or to take a chance on you as an individual, I got to show them something. When we look into a credit score and there are no trade lines, it is very difficult to obtain a mortgage, because when it goes down to it, either there's no credit history or it's too new. When it goes down to what is the minimum time that I should have active revolving lines of credit, the answer to that will be 2 years or more. The longer, the better. Remember that we're not asking for $10 to have Subway. We are asking for $100,000, $200,000. So when it goes down to having credit that is stagnant and it's not moving, it's one of those things that also doesn't help your credit. Having a line of credit that doesn't have activity, the term revolving line of credit, it has to revolve. Use it, pay it. Use it, pay it. That creates a pulse in the system and basically shows that you are using credit responsibly. And that's one of the things that creates some issues as well. The score is not all the picture, but it is important. because when you're purchasing a home, somebody's going to take a chance and they're going to measure risk according to a lot of different factors. Let me read another one of the questions. When it goes down to, let me see what else we have. How do I obtain a copy of my credit report? You do have the ability to obtain a free copy of your credit file. Let me be clear about this. If you go into annualcreditreport.com, everything on one page, this actually takes you into the page for TRW based in Atlanta, Georgia. You can download or request a copy of your credit file once a year, no cost to you. You can do it in writing, download the form. You can call the number in the page, or you can do it online, whatever you feel comfortable with. I advise my clients to go into the Federal Trade Commission webpage, F for Federal, T for Trade, C for Commission, .gov for Government. And they have a whole section on credit, on how to obtain. They have the links, they got the forms, and there's a lot of information in there. Or contact us. When it goes down to it, it's one of those things that you need to understand the information once you get it back. One of the things, one of the questions that we have is, how long does it take to increase your credit score? It's a process. It's a process. It's a process. So when it goes down to it, that's one of the things that you can always approach a coach that can actually help you to understand the information that's in the credit report. Because when it goes down to it, normally the changes to, once you begin and you start doing what we need to do in your particular case, depending on what that is, whether we need to clear information that is incorrect, whether there's the balances we're carrying are too high. Normally it takes between 2 to 3 cycles, means between 60 and 90 days before actually you do something today, it will reflect within the next cycle or 2 cycles. Some cases are longer than others. And when we're looking into assisting clients to go into a process into successful home ownership, I always tell my clients, it's like you got to start working on your credit as soon as possible, because some cases are quicker than others. It could take us 6 months, it could take us a year, depending on your case. So when it goes down to obtaining a copy of the credit report, does this have an impact? Hold on, let me read the question. Would it have a negative impact on my credit score if I look into my own credit report? The answer to that is no. If you request your own credit report as a consumer's request, you actually have the right to obtain that information every day. It's not going to lower your score. The moment that a third party looks into your credit report, it will lower your score. Just to give an example, I'm a certified financial coach, and we assist clients through the process. We are a housing and counseling agency. We can assist clients, and we can obtain a copy of the credit report for them. And I really, really try never to pull a copy of the credit report for a client. I'd rather take the client and empower the client with the ability to do this on their own, so they can do it from now on. Not only that, but at the same time, there will be no impact on the score. A third party looks into your score, in the majority of the times, the impact will be, it will lower your score because of other factors that affect your FICO. When it goes down to it, when should I start working on my credit report? As soon as you can. The whole mentality on giving access to all clients or all consumers to the credit report is to make sure that they understand what is being reported. And you'll be surprised the amount of credit reports that have errors in them. I think that the last study was about 77% of credit reports had negative information on a credit report for a client that the client was not aware of, and it was affecting their FICO score. Do you advise hiring a company to assist with the clearing of your credit, or should I or should the person just take time to do themselves? And when it goes down to it, there is a purpose and there is a use for such companies. Clients are having victims of ID theft, clients that share a common name with somebody else that has issues. From my experience, when a client begins a conversation with me that they need to clear, or repair their credit, I'd say 9 out of 10 do not need to go outside of the tools available to them. If we know that the information in our credit report is accurate, it is accurate. We have to own it. If I didn't pay the cable bill 4 years ago when I moved, and now it's in my credit report, is there any way that I can remove that information from my credit report? And the answer to that will be no, not in a legal way. Now, there are things that you can do in order to improve your credit position. The way I look at the credit, not only the pulse, there's got to be a pulse. It's a living thing. But when it goes down to it, it's like a broken heart. When something is going to hurt your credit, it's going to hurt your credit immediately. And when it goes down to it, once our situation levels out, then we can begin the process to make your credit stronger. When we look into the publications that we have one publication on credit repair, and we have another one on credit rebuilding. My coaches spend the majority of the time on the rebuilding people's credit position, making their credit look pretty. At the end of the day, when we go into this process of asking for a mortgage, we're not asking for $10. We're asking for hundreds of thousands of dollars. So there's nothing wrong with what 4 years ago I went through a hard time. I moved from one place to another, and some things actually fell behind. Here we are 4 years later. Now we can actually begin to take care of those things. By going through the process of pre-qualification, when you actually speak to a specialist with the credit union, they'll be able to look into your credit report, and they'll give you some advice. If you use our coaches, that's actually what we do. We'll take a look into your situation. We do it in a very specific manner. We always talk to our clients of what the goals are. It could be that you're looking into becoming a homeowner. It could be that you're looking into creating a savings account, or creating an account for your kids for college, savings. It could be that you want to buy a new car. Your goals are your goals. And when we go into working with a coach, basically will help you design a plan on how do we go from where we are to where we need to be. When it goes down to credit, is the one thing that I can always say that it depends. It depends. Every case is individual. But they basically, this is what they do. My credit coaches don't do anything else but coaching on credit. Any other questions? Well, keep in mind that you can always reach out to Charmaine or her team on any of the 4 branches that Prince George's Federal Credit Union has available. Keep in mind that only 2 of them are working on Saturdays, but they can put you in the right direction, and be more than happy to help anybody in the future. I do have time for one more question that just came in. Does having a low amount in your savings account have a negative impact on the loan approval? And the answer to that is that it depends. When it goes down to your savings, depends on how are being earmarked, because you are going to need down payments to cover the down payment costs. In some places, they will look into not only the down payment but also the closing costs. How much money are we coming to the table, regardless of the program that you're going to use. Some of the programs, for example, like FHA, required a lower down payment. So we're looking at less than 4% down. But if you got to put 4% down and you have to cover 3% on the closing costs, that is quite it could be quite a bit. One more question because it just came in. If my name is on my previous home and my ex and I want to buy another house, can I get another house and can I get the name removed from the loan? When you create a financial instrument, which is a mortgage, in order to remove your name, basically the quick answer to that will be refinance the property. One more question: what if you have new cars? Would that be higher hinder for getting a mortgage? I don't want to say hinder, but it's something that you got to keep in mind when we're thinking about the front end, and then we talked about the back end. On the back end, just to give an example, if you're making $50,000 a year and you owe $50,000 on a car, your back end ratio is going to be pretty high. However, I don't want to say that will hinder because you have to talk to a mortgage specialist when it goes down to getting the numbers, and that is something that Charmaine and the team on the credit unit will be able to help you. Charmaine, are you on the line?
Yes, George. Yes, I am.
Well, I'm running out of words and out of breath.
All right. Well, first of all, we'd just like to thank everyone for attending today's housing and mortgage webinar. If you'd like to learn more about Prince George's Community Federal Credit Union or anything that you've heard today, we welcome you to speak to one of our member service representatives. George, can you advance the screen to the next slide there? You could visit us online at www.princegeorgescfcu.org or just give us a call at 301-627-2666. Again, I'd just like to thank our presenter, George, and also Coffee for their support in the partnership and presentation of this webinar today. If anyone would like to schedule a free 60-minute financial coaching session with Coffee, please give them a call at 866-459-5165. Again, the number is 866-459-5169. Pardon me again, 5165. And if you have any questions concerning, again, the mortgage process or you'd like to get started with your application, please feel free to contact us at the information located on your screen. Thank you once again, and have a wonderful afternoon.
Thank you.
Goodbye.